Welcome back to Pipeline Trading. In today's session, I'm going to bring together all the major smart money concepts and show you how to apply them step by step. Think of it as building a complete trading framework where market structure, imbalances, liquidity, supply and demand, and trade management all come together like pieces of a puzzle. My goal is to give you a practical, easy-to-follow plan that helps you spot high-probability trades with confidence. This strategy works across two layers. First, I use the higher time frame to set the bigger picture, defining structure, spotting imbalances, marking liquidity pools, and identifying supply and demand zones. Then I shift into a lower time frame to refine entries and confirm the trade. This plan works on any chart or market, but as always, make sure you backtest thoroughly before trading with real money. To make it simple, I've broken the process into 5 clear steps. Let's dive in. The first step is analyzing market structure. Market structure shows me who's in control, buyers or sellers. A series of higher highs and higher lows confirms bullish conditions. For example, if price breaks above a previous swing high and then forms a higher low, buyers remain in control and the trend is likely to continue. As long as price stays above the most recent swing low, the bias is bullish. Of course, the market doesn't always move in perfect textbook patterns. Most of the time, price action looks messy. Even so, I can still identify the most recent structural break, mark the swing high and low that define the trading range, and treat everything inside that range as internal structure. This keeps me aligned with the broader trend. The second step is fair value gaps. A fair value gap occurs when price moves so aggressively that it leaves behind an imbalance in area where little or no trading took place. On a chart, this shows up as a gap across 3 candles. Why do I mark them? Because markets often return to fill these gaps as they seek balance. When a fair value gap aligns with a supply or demand zone, it becomes even more reliable. A bullish fair value gap shows heavy buying. When price revisits the zone, those buyers may defend it, creating a strong opportunity for long positions. A bearish fair value gap shows aggressive selling, and when price returns, it may provide an entry for shorts. These zones act like magnets, and as a smart money trader, they're some of the first areas I highlight when analyzing a chart. The third step is liquidity. Liquidity is about where orders sit in the market. Large players need liquidity to enter or exit positions, so they target areas where stops and pending orders are concentrated. The most important liquidity levels are swing highs and lows, equal highs and lows, turning points, and daily highs and lows. Institutions often drive price into these zones to trigger stop losses and collect liquidity before the next major move. Recognizing this behavior gives me an edge because I can anticipate sweeps before the trend resumes. The fourth step is supply and demand zones. These are areas where strong buying or selling push the market sharply away. To find high-quality zones, I look for 3 things: inefficiency, a break of structure, and the push distance. When price revisits these levels, they often act as strong reversal points, especially if they align with imbalances or liquidity sweeps. For example, on the euro-dollar 1-hour chart, an impulsive bullish move created a demand zone that checked all the boxes. It left behind a fair value gap, it broke previous structure, and it pushed the market significantly higher. If price retraces back into that zone, the probability of a bounce is very high. The fifth step is execution and trade management. Once I've identified structure, gaps, liquidity, and zones, it's time to execute. The process usually looks like this. I wait for price to retrace into a marked supply or demand zone. I drop to a lower time frame to refine my entry. I place the trade with defined risk. And then I manage the position by trailing stops with each new structural break. For example, let's say euro-dollar shows a bearish structure on the 1-hour chart. I mark the trading range, highlight a fair value gap that aligns with supply, and wait for price to retrace. Equal highs form nearby, signaling liquidity. Once price taps into my zone, I move to the 15-minute chart and enter short from the candle that created the gap. Thus, price moves in my favor, I trail stops above each new lower high. This way, profits are locked in while still giving the trade room to develop. In this case, the trade reached nearly a 1-to-4 risk-to-reward ratio, all while following the rules of the plan. By combining market structure, fair value gaps, liquidity, and supply and demand, I build a trading plan that adapts to different conditions. It's a rules-based approach that helps me trade alongside institutional order flow instead of against it. That wraps up today's full guide on smart money concepts, brought to you by Pipeline Trading. If you found value in this breakdown, make sure to like the video, share your thoughts in the comments, and subscribe so you don't miss my next deep dive strategy. Thanks for watching, and I'll see you in the next episode here on Pipeline Trading.